All right, greetings. Happy end of CPI day. We survived it. Thank you very much for joining me and Craig Shapiro. We are from LaDucTrading.com. I'm the founder, and Craig is our resident macro advisor, also hedge fund manager. So we decided to do a little impromptu plan for discussing CPI and all that is happening in fixed income credit forex world. And also just to kind of reassess, where do we go from here? Is this the capitulatory low, or do we still need to know what we own? So with that, Craig, thank you so much. I know that you have just kind of reemerged after Hurricane Ian, which was a big drama.
Yes.
Craig actually has been a longtime client of LaDuc Trading, and then moved down to his home in Naples with his wife and 4 kids during COVID, and then just got obviously hit very hard with the recent hurricane, and sprung right into action with his family to do community support. So he's kind of re-entering in this market dynamic we had of major gains in 2 days of last week, completely unwound by end of week, which was a really nice chasing environment in both directions. And then today we had our CPI, which was a beat. Market decided after Europe closed to spring forward in a very big chase for those scalp longs. But the question remains, despite this very strong bounce today, do you feel that the lows are in, Craig?
I don't. I think the framework that I've been using to try to understand the trend of the tape and where things are going has been largely driven by net liquidity that the Fed is either putting into the market or taking away from the market. And we've seen all year with quantitative tightening, with builds at the reverse repo window, with builds in the Treasury general account, that liquidity is being contracted, and the rate hikes obviously are accelerating that as well. So the CPI print today was another strong hot print. And if you look at some of the measures like the Atlanta sticky CPI or the Cleveland trim mean, these are all highs for the year. So it's a broad range of inflation that is beyond what we saw early in the trend about used cars or gasoline or what have you. This is wide ranging inflation that is spread throughout the economy, and is creating conditions that make it very challenging for the Fed to change its course or provide liquidity again. And it's my view that you need liquidity. The market needs liquidity in order for stocks to work, for risk assets to work. So as we extend the timeline to when we're going to get that again, we have a risk off environment. So today with the CPI print, I thought the bond market reacted kind of appropriately. I mean, we have rises in the terminal rate up towards 4.85 or 4.87%. Euro dollar futures for March and June of next year have 5 handles. Even the long end was weak. Curve flattened a bit, but we had a bond auction today, and everyone's underwater in that purchase. So I think fixed income reacted appropriately. As far as equities are concerned today, look, I mean, I thought the reaction right at the onset when NASDAQ was down 3+% made a lot of sense, because felt like that was the risk market saying we have a problem here. The Fed's not going to be providing liquidity anytime soon. Multiples will contract. Inflation is high, earnings momentum is negative. That's the right reaction. And then, as the morning progressed and put monetization kind of kicked off and vol compression accelerated, which tends to happen after a binary event like we had, markets really went crazy. And I think you put in the chat, and it had been going around, that client or somebody bought 23,000 3,600 calls for tomorrow, paid $1.30 and change for them, and they went, and that created a massive squeeze and massive.
They went to 50, 60 within 10 minutes.
Dealers scrambling, buying upside, delta hedging. So it almost, it created a kind of self-perpetuating, motion machine that just went haywire. And I would say also, FX markets today acted, bizarre in a way. We had that stuff overnight or in the early morning that the UK was considering kind of going back on some of their fiscal, spending plan, that maybe there'd be a raise in the corporate tax rate, or something that would make it so the budget wasn't as expansionary. That helped the pound rally materially, and I think kind of left people off sides today. So a lot of what I think we were seeing was some of that vol compression, which levitates markets, and then you had this big alpha unwind because crowded positioning was kind of getting hit. And so as managers are taking down risk and taking down both sides of their books, these crowded positions were getting unwound. And so there was a lot of that going on too today. So you had a bit of an alpha unwind, you had a bit of vol compression, and NASDAQ finishes up 2.5%, and people feel like maybe the bottom is in, but I don't know. I think fixed income markets are right in this case, and we'll see. I mean, I suspect over the course of the next few days or weeks, more of this reality will set in about the end of the Fed pause thesis, and kind of continuing to push out these rate hike expectations.
Correct. And I posted that this morning in Market Thoughts when we closed the room. I said, this VIX chart is going to kind of show the way, which is as this weakens, obviously scalp longs have the wind at their backs. And then a client posted, we had a massive, delta hedging unwind here with that SPX 3600 call. So it was a significant amount of delta to buy. So we did have a very sharp scalp, but big picture, I did also, same idea, which is that we still have Bank of England tomorrow, right, which is removing accommodation, and pension funds barely made it out alive last week when they were in serious trouble, actually 2 weeks ago, excuse me. And intraday, we did have some dollar swaps that were quite interesting on an intraday basis. I just want to kind of show that on the chart. We were tracking this in the room with the British pound really reversed intraday. Same thing with the euro across the board, but they're still in protracted downtrends. So this is still not a safe looking bet in either case, especially for the pound sterling. So this is definitely a bounce that we had right back into resistance, but until it gets and closes above this and moves higher, it's still in a protracted downtrend. But then the same thing with the yen and the yuan. We had some massive push higher, which we've been looking for, right? The Bank of Japan line in the sand, 145. It continues to percolate higher. This is definitely risk off. You've been warning about this since a long time, and with the dollar yuan as well since April. So this is definitely coiled. It's still moving higher. Again, we had this very large reversal, intraday, which caused also the help of the put monetization. I absolutely agree with that. So where do you see us next? We have the CPI out of the way, so to speak. It was obviously quite bullish. We have Bank of England tomorrow, removing accommodation. We still have a lot of FX risk. There's no question. I would say we got a lot of technical short-term levels that just triggered, meaning we had just, 3,500 SPY, nice place to cover. But we still have protracted monthly rollover in very key, big picture NASDAQ levels that are very unlikely to hold, in my opinion. So where do you think we go tomorrow with Bank of England?
Yeah, I mean, so the Bank of England is supposed to kind of cease gilt purchases, I guess, as of the close tomorrow, and so really, I think that's really more of a weekend, a weekend risk type thing. Are they going to announce something over the weekend that says, we're serious, we're not going to be supporting? Are they going to say, we're kidding, we will support? Is the is the government going to announce something? I know there was some back and forth today where the chancellor said, we're waiting till October 31st when we get to decide. So I'm not sure. I think, the QE that the Bank of England did was very important. And so if they take it away come next week, I suspect we're going to see, fixed income selling again. I was noticing earlier this, 10-year gilts yields are 4.2% and 10-year treasuries are, 3.95. I mean, I don't know. I feel like yields in the UK should be way higher than yields in the US, kind of given the inflation position, given the net energy situation. So, but, as we transition, into tomorrow and into next week, the market becomes a little bit less macro and a little bit more micro in some respects, because we have earnings season kicking off, and JP Morgan starts tomorrow, and kind of all the banks are in either tomorrow or Monday. We have a ton of industrial and cyclical earnings next week, and then big tech earnings of the week after. And typically we get kind of correlations falling during earnings season, as certain things do well, certain things do poorly. Positioning obviously is very important. How are guys positioned into these prints? How do the early reporters react to good news or bad news? Often dictates, whether or not multi-manager community will want to own positions for these prints. So I think JP Morgan tomorrow will be very interesting. Just obviously a big move today off the lows and decent volume there. So bank earnings, I don't suspect they're going to be very good, but we'll see the reaction, and that might help set the stage for what next week will bring. But as far as the underlying trends are concerned, I mean, the other thing I would say is tomorrow we do have 3 Fed speakers: George, Cook, Waller. Waller's talking about CBDC, so it may not be the right forum unless he gets a Q&A. And then we have Bullard over the weekend. So look, I think the Fed messaging is going to continue to be one of inflation is out of control. We need to keep tightening. It's broad throughout the economy. Our rate hike plan is set, and we don't really anticipate changing that. So I don't think there's going to be necessarily anything materially incremental that comes out, but it should be a continuation of that hawkish messaging. So tomorrow also is retail sales, and UMISH inflation expectations. And one of the things that I'm watching for is what are the types of signals we could get that would allow the Fed maybe to slow down its rate hike agenda. You're not going to see that in the real data. You're not going to get that in the inflation data really anytime soon. You're not going to get that in the labor market data, which has been incredibly robust, a very tight labor market. And, the Fed is looking for, jolts to go down, to soften wages, to soften the wage price spiral. And this is going to take a long time. So, how could they really pivot based on either one of those things when they're kind of both well above mandate? It's hard to believe. But on financial stability, that is the place where, market participants seem to think the Fed is, always ready to provide liquidity in case things get out of control. Waller last week basically said there's no issues right now. And most of them have kind of reiterated that. So for me, I think we would need to see a kind of significant fall in inflation expectation yields, break-even yields, some forward indicator of inflation becoming unanchored again, but this time to the downside, where a deflationary bias, a deflationary bust backdrop was starting to get priced in. We're just not there.
Yeah.
These five-year, inflation expectations or break-even yields are up. We're up another 2 basis points today. They're up like 15 or 18 basis points in this month. So, and across the entire curve, 2-year break evens are up 15 basis points today. Largely that's energy driven. So the Fed is really running the risk again of this bizarre dynamic where the market front runs their behavior, starts to go risk on, and we start to loosen financial conditions again in a way that makes it impossible to kind of solve the inflation dilemma. So right now, since I don't see CPI turning, I don't see labor market turning, and I don't see inflation expectation yields dropping, I don't see how the Fed is going to be able to move off of this hawkish tightening agenda. And so that's the, that's the reason for my continued kind of negative outlook on risk assets, kind of through the weekend and, through the end of the month and into next month.
I'm showing a post. I'm obviously in agreement, and I love how we come at it from very different perspectives. Your macro view, obviously, and the granularity of what's happening with the economic data and the credit markets as well. You also track liquidity very closely, which I do. I come from it from an intermarket perspective largely, and then drill down to the micro and just kind of revisiting this deflation of wages ended with COVID article that I did a year ago. I bring this up because today I posted for clients an update on that chart. This is the exact chart that I had in that post from October of 2021, with the whole premise that wage demand would be lagging. It would be very sticky. It would increase. It would outperform in time productivity. That would be the enemy of bonds in a nutshell. So spied basically this large kind of head and shoulders on this 40-year channel of the 30-year Treasury bond price. And this is it today. And I continue, and I know it pains a lot of our, larger institutional clients that have a solid holding in the bond proxies, but the fact of bonds and bond proxies, it's not done going down. So every month, every week, I'm going over, is there a bounce area? Is it safe? Is it done? And I still contend that this inflation is more than sticky. We've been on that rant for 2 years. Wage inflation is very strong, kind of a Goldilocks, if you will, right now with this low unemployment, and the jolts that are coming down are actually being replaced by job, they're filling the positions. So we've got a ways to go before the Fed tightens their grip, loosens their grip. But I still think, regardless, this head and shoulders has played out really well. We still haven't based. We have to base. We have to then turn and follow through and move back higher to be bullish. And I know that many people are looking at TLT as a great opportunity to also kind of go in for, multi-year wins here. But I contend that they're still trying to catch a falling knife. So this is a chart that I gave clients back in June and just of last year. And it is definitely, we sliced right through 105, which actually surprised me how weak it was. We had no substantive bounce at all. And I was expecting we might have a little bounce into resistance before a fall. We didn't. We just fell. We fell right through to 199. We've had a minuscule bounce. There's nothing here that says this is safe yet. So this higher yield regime and lower bonds is still big picture my main theme. And then the bond proxies. So if you take Apple or Tesla and basically put together a ratio as it relates to the 10-year, you can also see when they rolled over and they're still meat on the bone short. So I'm not seeing, and especially Tesla, oh me, oh my. So as it relates to these growth plays, mega cap tech, the generals of Apple and Tesla, for example, they're the last ones to fall in this NASDAQ underperformance for 2022. Just like in 2000, it was Cisco, right? And all the little ones fell. The big high flyers, the high PE plays absolutely were demolished. And then the generals fell and the market continued down for another, 40, 50%. So I'm seeing the same type of risk, big picture. That's not to say today wasn't a hell of a short covering rally, but it was of such short duration right before the weekend risk that it's hard to take it seriously. So do you see that?
I think, often we get these counter trend moves that seemingly come out of nowhere. And as you're sitting in front of the screen, it kind of creates a narrative in your mind that, something is fundamentally different, or people have figured things out that you haven't figured out. And the collective wisdom of markets, is moving past whatever thesis you're espousing. But a lot of times it's just, the dynamics of daily option activity.
Mm-hmm.
And squeezes and positioning, and it's really nothing but trying to shake people out of positions. And bear markets do a great job of killing bulls and bears, and I think that's what we're and that's what we're experiencing. But, just kind of stepping back from what today's data really said, was that the Fed thus far really has had no evidence that what they've been doing is working.
Clearly, very, very
And,
clearly.
you just have,
Except to bid the dollar higher.
yeah, and look, I think, there's, some interesting dynamics, in play there about what the dollar strength, in this kind of energy environment means for our allies, what it means for Japan, what it means for the UK, what it means for Europe, these countries who are, unable to procure cheap energy anymore since they're not buying from Russia. It's putting them at a significant competitive disadvantage against the rest of the world, and against the U.S., who has a very sizable domestic energy presence and can continue to buy cheap natural. Our manufacturing companies are continuing to buy cheap natural gas, and so from a global competitive position, the U.S. remains in an incredibly strong situation. But as the dollar rallies and as energy prices remain firm, the UK, Japan, and Europe have to continue to sell US dollar assets in order to pay up for energy. And the selling of those assets are often treasuries, which is putting pressure on yields, which is strengthening the dollar more, which is creating a bigger currency issue for those countries. And we kind of are in this doom loop scenario, where the currencies are becoming the outlet. Certainly in Japan, the currency is the outlet as the government continues with with yield curve control. But in the UK now, the currency and the bond market have become an outlet, and I suspect Europe next, the bond market will become an outlet in Europe too, because I don't suspect that Europe has any real ability to control this inflation situation because of their energy import needs. And so I think that dynamic, remains with us, for weeks, if not months. And what I think the U.S. has done with the SPR release has helped keep energy prices down, which has slowed down the need for those countries to sell U.S. treasuries in order to raise dollars to buy energy. But we're getting towards the tail end of the practical ability of the U.S. to continue to sell from the Strategic Petroleum Reserve.
Yeah.
And so,
Terms.
right, and if as that starts to become noticed, and crude prices, find a bottom, see maybe they have, and start moving higher again, that's going to put more pressure on these countries again to start selling more treasuries, pushing yields higher, weakening their currency, strengthening the dollar. And I think that dynamic will stay with us. So, it just doesn't seem like a great outlet for risk taking.
Yeah.
And if we get the earnings coming through tomorrow and into next week that are not great, people will start to take down numbers significantly for 2023.
Before we jump to earnings, I want to just address this chart that I have that I'm sharing of WTIC, which is on a weekly. Granted, we're not quite there yet. It's only Thursday after market close. But I have, as you know, right, this 93, 94 area has been like a big deal from when we hit that 130 back in March and then kind of traveled along this trend line from November 2020 to November 2021 and now approaching November 2022. The point is, this is a weekly level that I believe if we get and stay above this moving average, it's basically 94 on a weekly, we will see higher oil come in. And I think that's going to also create some of that ripple effect. We have also a chart that I love to show of earnings, which is on a monthly, not a weekly. And again, that's WTI crude oil. I really like this chart for higher. It came down and tagged that 75, 77 area. It actually hit a low of 76.25 and then bounced quite firmly. Even though we knew OPEC was going to be cutting, it didn't sell off after very aggressively. It should have been by the rumor of OPEC cutting, sell the news, and it still continued higher and it closed extremely well. And basically, it is looking pretty darn bullish if you ask me. Even USLD, which is not a really common futures vehicle, but we had this inverse head and shoulders. It broke above this trend line from June and it has based, and it's also looking like it's going to intonate higher. So I had a baseline bet that if we broke below 93 on the monthly, we would move lower into that 75, maybe even overshoot to 65. We got stabilized at 75 in crude. And then basically SPR releases be damned. Oil is still firm. Oil is still rising up. Oil still looks bullish. So if we close above 94, I think we're going to see a higher spike in oil as well as in yields. As you know, you and I are both very, inflation is sticky. I think yields have more to go and bonds have more to go, obviously, inversely. But now we have earnings coming up, and you were just talking about earnings. And I know this is kind of a campy little hangout here of shock and awe, but this goes back to the 1990s and it's GAAP SPX. I know that may not be as popular and sexy as many do their accounting these days, but it's a fabulous intermarket tell for when we have nice trending environments, when we have overbought and oversold. And clearly from COVID, this bubble that we have seen now unwind in a lot of tech plays, but across the board weakness. And now they're definitely ratcheting down their expectations. We're just about ready to cross over. So I kind of joked when I posted this last week that a retest is in the cards, right? So we're, earnings expectations are coming down. That's pretty consensus right now. That could be the soft landing that the Fed's talking about. Otherwise, this is going to be a kind of fake breakout, fast failure, and fall back inside trend. And then that would mean we've got lower to go. So I think this earnings season, look where we are. I mean, this is just, it's not going to stay here very long. This is a monthly chart, but it's absolutely intonating a break lower. And obviously we've got some price action to support that. But what are your thoughts on where this might end up? How bad do you think it's going to be?
Yeah, I mean, that's a good question. I think kind of garden variety earnings recession, if that's all we get, maybe in the 20-25% range down from in 23 versus 22, or one half 23 annualized, or whatever the numbers may be. But with yields still in this 4 to 5% range, I mean, it's kind of hard to really hard to see why it might not be worse. And so I think that's the big question. Certainly there also will be a shift in the dynamics of earnings, right? I mean, we'll get, because of this upstream commodity tightness, we'll have energy prices, energy companies that are reporting reasonable earnings and reasonable earnings growth, and tech companies and consumer cyclicals will not be. And so given the composition of indexes, it's just, I suspect that we're going to see strong earnings declines year over year, coming from those sectors. And my supposition is it will be worse. It'll be worse than a 25% fall. And so then the question is, if we're talking about 175 or 180 earnings for next year and multiples in the low to mid teens, I mean, that's how you start to paint the picture of a market that's less than 3,000 over the course of the next 6 months, because we should start to be pricing that in here as we turn into the new year.
So I'm showing right now, this is forward earnings, but obviously a kind of a parabolic top that is now in distribution. We haven't even really rolled over yet. Definitely I'm skeptical as well. I see not only my GAAP SPX chart as dangerously close to a strong rollover, but pretty much we've seen this peak in liquidity, which you have your chart to demonstrate that. I'll bring that up. You sent that to me in DM. Obviously peak valuations, we're just unwinding the bubbleness of it all. And then of course peak earnings, we're intonating down the mountain, finally dancing down the mountain in earnings. Price obviously front ran that. Hunter's asking about in semiconductor land, given global tensions with Russia and China, do you feel semis are still overvalued or have a long way down, to go? He knows my thing. I call it there's still a lot of meat on the bone short for semis. Obviously, timeframes matter. But what's your sense in regards to semis and global tension with Russia and China?
Yeah, I mean, I think, semis kind of will react, quicker because they're more cyclical. And so earnings, expectations, in the sector have come down, I would say, maybe faster. So maybe valuations are more attractive than some of the high beta tech stuff. But, I think in a bifurcated global supply chain world where we're deglobalizing, semis really are at the center of that in a lot of ways. And so, is TSM going to be, moving towards the east or moving towards the west? I mean, these are big geopolitical questions that are hard to navigate, or hard to know kind of right now. But I think, having an understanding of this geopolitical environment is going to be important for how you trade, these spaces. I mean, if we start to get, more domestic capacity growth in the U.S. because we need it here, and then China does their own thing. I mean, it's maybe there'll be a bottom for for semis earnings because the U.S. needs to build up its own semi industry, or the West needs to build up its own semi industry. But again, I think for now we're still talking about significant earnings, negative earnings revisions, and I think that's that'll trump kind of this geopolitical wild card.
And I have a chart, Hunter, which I posted as well for clients to kind of show this rollover in semis. It's a ratio chart with the S&P and how we've broken a trend line. We've got some lower levels. It's very similar, obviously, to the one that I do with NASDAQ, right? This is how it started in January and NASDAQ to SPY, and this is how it's going, right? So there's a big component of semis in this, tech filled mega cap as well with Nvidia, with mega cap tech, and with the larger NASDAQ. So I still see some room for lower, long story short, in semis. And unfortunately, I have to keep coming up with lower price targets because they continue to have a protracted downtrend. So it's really tough for me to see this earnings season, of all earnings season, as the place that we're going to bottom and turn and move higher in semis. I definitely don't feel that way. I think energy is still, as he asks, energy for many years, do they have some strong growth? Definitely, he's kind of noting the bad green policies, but ESG initiatives. But do you think it's dividend safe haven? So how are you invested in energy plays?
Yeah, I mean, I have some, it's really the only sector that I have, some length in my overall portfolio. I have some domestic U.S. E&Ps, like an NOG, and sometimes XOP in there. I have some global tanker stocks like STNG and Frontline. I think those are interesting plays as the world needs to, find more oil and store more oil, and oil becomes a reserve asset as countries, don't want to hold or can't hold U.S. treasuries anymore as reserves. So, having access to oil and storing oil is important, and there's just not a lot of new supply coming in the tanker industry. LNG has been another name that I've had that's worked. It's
worked really, really well. I'm putting up a chart right now of those three that you just spoke about, and this is hours, so ignore. This is the weekly chart. It has been a perfect trend trade, staying above the 10-week, and I might add very, very few, like I can count under 20 that have this type of gorgeous 45-degree angle staying firmly on a close above the 10-week. LNG had a little bit more distribution. I remember when you recommended this, oh goodness, this was, I think it was below 80, wasn't it?
Yeah. I think it was in that period down there.
But it's been gorgeous as well, no question about it. And then a recent one of yours, meaning like 6 months ago, was Frontline, and it has a little bit more chop to it, but explain,
Yeah, that's definitely more of a higher beta volatile name, high leverage, high debt, situation. But Well, yeah, look, I think broadly energy assets are, particularly Western energy assets, US energy assets, or whether they're ships, whether they're, E&Ps that own, production capacity, pipelines. I think, again, in this world where we need more calories and where certain countries can only buy from certain other countries, there'll be premiums paid for energy assets in Western jurisdictions. And so, that's been an area of focus. I know uranium has been, kind of on and off. I think there is a trade, general structural trade there. I don't really have too much, exposure, but it's another area to kind of fill the gap on the energy side. At times I don't just that some of the fertilizer names or a rare earth name. I mean, again, these are US, basically the thesis is own US commodity producing assets in a world that's kind of short commodities, and in a world where Russia supplies are not available to many countries in the West. So there's a kind of wide swath of names and industries where I have some long exposure, but broadly speaking, they're still stocks. So it's
What's your
hard.
What's your position on gold?
So gold I've been starting to buy upside calls, and gold balls come in. And it kind of acts as a hedge to a long dollar view that I have and express in my portfolio. And ultimately, I think at the point in time when markets get too unwieldy or the dollar strength becomes too much of an issue for someone, whether it's Japan or UK or whatever, and then things start to break, gold will anticipate the eventual release of dollar liquidity that'll come from the Fed. And I think the Fed doesn't want to. I think the Fed is holding out, right? They don't want to be providing liquidity, right now, for the reasons we spoke about earlier. But eventually, if things get too unwieldy, they'll be forced to, and they don't want to be releasing liquidity when inflation is high. But ultimately, we may get to that point. And I think gold will anticipate that eventual release in liquidity. I was listening to Julian Timmer from Fidelity was on earlier. He was just talking about the relationship of the real yields with gold and how it's kind of broken down. I mean, basically, real yields have been rallying. 2-year real yields are up above 1.5%. Let's see what they're close to. Yeah, about 1.49%. I kind of would intonate gold down in the low 1200s or 1100 or whatnot, and gold's 1700. I mean, there's something going on. I mean, we could, we don't have to talk about kind of this geopolitical angle with Russia and what Russia's trying to do to kind of sell its energy in gold or in rubles or anything other than dollars. But I think there's a place for gold in a new monetary world order regime that I think is being developed. And so I definitely want to have, some exposure. So for now, I've just kind of been playing it with upside calls. The chart doesn't look great, but I'm just kind of been, nibbling at it, and but do think as things get worse, gold will relatively outperform, and then as we get closer to that Fed liquidity release, gold will perform absolutely.
All right, so that backdrop is very, very helpful for me to hear, because I tend to not see a benefit at all to gold's wonkiness outperforming SPY until this particular intermarket chart gets bid up and gets sustainably over 0.5, 0.55. This is again gold, which is continuous contract to S&P, and it's just really not obviously it's not falling as quickly as SPY of late, but it's absolutely not a safe bet. But at some point it will start to get bid up, and I think it will run much faster than SPY, but it hasn't gotten there yet.
Yeah.
So it's pretty much a tell on this monetary policy failure, and that's the worry is when it starts to get bid up, we're really in trouble. So I tend to not spend too much time on it, but I want to get your thoughts on where does it make sense to kind of, because it's done nothing, right? But fall in,
yeah, I mean, but if you look at gold and yen, But if you look at gold in yen terms, or gold in pound terms, or gold in euro terms, like, it's doing much more of its job, right? If you're a citizen of one of those countries that's facing, rapidly deteriorating currency, it's
Yeah.
just, like gold in dollar terms is, for us, it's not, kind of not doing,
It's also, it's not cash, right? So that's the migration is absolutely clearly to cash, as this chart by cross-border capital kind of shows. So there's no question, gold is not in favor, cash is.
For sure.
All right. So the liquidity chart, speaking of liquidity, I want to bring up that you have shown before. Hold on one second. Has been very, very helpful to your thesis to be max bearish. And I think in this latest go round, when we topped in August, and I just want to kind of show this, my view and then your view. Okay. Let me just get this here and share. I have been on the view, this view that obviously we've been in distribution, sold to you top, and every, short the rip, short the rip, short the rip. So now we're really continuing to kind of dance down this mountain. There's nothing so far in breadth, like advanced decline. We've also come out of this channel from 2009, et cetera. NYSE, NASDAQ, it doesn't matter. We're in distress here as it relates to, getting bid back up, but at least it's been orderly. We haven't crashed. You have a liquidity chart I want to bring up and ask you, how do you use this? Because I think it's brilliant. And let me go to it and find it. You sent it to me. Where is it? That's here. That's yields. I don't know if I got, yes, here it is.
Yeah, I mean, look, this is, I think many people have looked at, kind of the correlation of the Fed's balance sheet with the S&P and noticed, a very sizable, correlation. So it's not, not particularly, that new. I've noticed others have, tried to parse the data a little bit more. I know Darius Dale from 42 Macro and a couple others have really tried to kind of get into some of the faster moving parts of this, where we get real time, or we get weekly, this weekly data. Actually, an update just came out just now, but it's basically just a measure of net liquidity, and it's the size of the Fed's balance sheet less cash at the Treasury general account, because as the Treasury builds cash, it's removing that cash, basically from the system, from banks, and keeps it at the Fed. So it's kind of not in the ability of investors to use to invest. So it's the Fed balance sheet less Treasury general account less the reverse repo, the amount of reverse repos, amount of money in reverse repo. And what's been happening is, because of where yields are and because of the ability to earn 3+% by lending securities to the Fed overnight, every night, we have built this reverse repo facility up, well north of, $2 trillion. And into quarter end, there's a dynamic where it builds sizably as banks and other funds are kind of forced to, from a regulatory perspective, to take positions down. So as that cash builds at the reverse repo window, we get this kind of risk off setting, and then that cash does get put back to work. So the first couple of days of October, we saw a sizable injection of liquidity. So now, again, that reverse repo should start to build again. The Treasury general account will build sizably over the course of the next couple of days, because there's a tax payment that's due tomorrow, Saturday, which gets paid for Monday. And we have QT. So today was kind of the first time that the Fed didn't bid for the 30-year bond. And there's decent size there's decent maturities on October 15th, and then again on October 31st. So, the Fed's doing 60 billion a month of Treasury QT, and another 30 up to 35 billion a month of MBS QT. So that will keep pressure on that, that white on that's the real yield chart. But maybe pull the other chart, but that'll keep pressure on this liquidity indicator. Will keep moving south. Yeah, that one. That white line, will keep moving south. Probably to the degree of a half a trillion over the course of the next 4 or 5 months. So we'll keep having pressure, and liquidity being contracted, and just that correlation to risk assets is tight, and it makes a lot of sense as there's less liquidity, there's less leverage in the system, less ability to buy assets. And so for me, it's not that I'm trying to kind of use this specifically and say this is the absolute level, this is where it should be every single day. But directionally, from a trend perspective, as the Fed continues to withdraw liquidity, it's very difficult for risk assets to move higher. You really have to be very focused on single names that are seeing positive earnings revisions, or sectors that are, and as opposed to just kind of this buy and hold passive mentality. Clearly that's not working this year, and it's not going to work when the Fed's contracting liquidity.
And now, since I brought this one up as well, talk to this the real 2-year versus NASDAQ. I love fractal.
Yeah. This is just another kind of fractal that I kind of noticed and put together. I mean, real 2-year yields moving significantly positive, or just really just indicative of how restrictive policy has become from the Fed. And there's reasonably good correlation of kind of forward multiples with where real yields are. And as interest rates and real yields are rising, multiples are compressing. And so this fractal would indicate a NASDAQ that should be significantly lower than here. And I think even for S&P, real yields above 1.5% kind of put you, from a correlation perspective, into S&P multiples in the 13, 14 times range. So you start to think about a 1.5% real 2-year real yield, 14 times earnings, a 20% earnings contraction in 2023 kind of gets you down in the 180 range. I mean, this is how you start to put in targets that are 2,500, 2,600, 2,700 on S&P, over the course of the next 6 months. And I don't really think that's out of the realm of possibility.
I don't think it's out of the realm of possibility at all. In fact, if FX keeps blowing up, I think we're going to get there sooner rather than later. And that was not my baseline bet. Once we pulled back, it's kind of ironic. I thought this would happen next year. It's been pulled forward. So this weakness below this, 3,800, right? My first of the year idea, right, for the market was we pull down 20%. So we did that. We bounced from 3,800 is basically this level that we churned around. But we hit the 3676, we bounced up to 4,300 basically, and then we just took out that 3676, tagged, a little under 3,500, and then this morning bounced up like a daisy once Europe was closed and puts were monetized. But that is indicative of an extremely fragile market, in my opinion, not the scalping long with suppression of volatility and the dollar pulling back and yield softening intraday. Those trends are still hot fire flames, right? Higher yields, oil's looking bullish again after this digestion period, and then for sure dollar is in more valued, let's say, if not very short supply relative to other local currencies. So I'm scanning not just the pound and the euro looking like they have further to go, shockingly, but the Swiss franc. I mean, whoever expects Swiss franc to actually get sustainably above 1. And I shared that chart yesterday that I really think that we're going to percolate higher in some currencies that are not normally risk on. So risk off, I should say. So this to me is going to be an important kind of weekend. And if we can stabilize and survive October, we'll have some seasonality in, end of year, November, December. Otherwise, I think we can absolutely take out that 3,500 and keep going lower.
Yeah. I had been thinking we were in this, potential, for lack of a better word, crash window, with the CPI and now the UK and, and into Monday. I mean, we'll see how the reaction is, tomorrow. Like I said, I think fixed income kind of is telling the truth here. And as we continue to push out the timeline to incremental Fed liquidity, I don't see that being a constructive market for risk. But positioning is stretched, although less stretched now after today.
Yep.
But yeah, look, I think the dollar liquidity is contracting. I think it's becoming and has been an issue for emerging markets, and now really for developed markets in a way that we haven't seen, in quite some time, maybe since, the late 90s with some of the EM crises. But what's going on now is you have these developed market countries that are at risk because they are the energy importers, right? It's the UK, it's Germany, it's broadly the EU, it's Japan. They're energy importers. Their current accounts are deteriorating mightily because of the strong dollar, because of this bifurcated energy world where they can't get access to cheap Russian gas or oil anymore. And so they're really under a lot of pressure. And it will be a question of how long can the Fed and the US administration kind of sacrifice our allies, or how long will our allies be willing to sacrifice their own economies and their own citizens, to kind of support this dollar system. I mean, I don't, that's a very big picture geopolitical question. That's, answers happen in rooms where we're not invited, but those are the important kind of things to be thinking about. But for now, even this week, Yellen kind of, said it's still our dollar, your problem. And I think as that continues, I think that's the reason why your timeline has been accelerated from what you were thinking. I think that's that dollar move, that contraction of liquidity, and exacerbated by the Russia situation, which has really prioritized kind of energy resources at the foreground of, the monetary order. I think I believe that's why things are moving faster now.
Yeah, I still, and I wrote about this, just kind of scanning through real quick before we kind of close in this macro to micro power hour. I was, before today's drop lower and reversal intraday, I'm still bearish, obviously, but I had warned, and I still believe that the crash puts are still in order. I still think that that's actually one area that we don't have. McGilligan from Nomura was actually a few days ago putting out that we still don't have. We have got low exposure and high cash, but we don't have crash puts. We definitely have, as far as I'm concerned, more meat on the bone short in bonds, bond proxies, and semis. I had mentioned back in August, if 2.6 on the 10-year on a monthly basis held, expect it to get and stay above 3.3, and then that would bring 4.3, 4.5, 4.7, and 5.3%. We've already made it up to 4. So this was a first quarter of next year, and we're already up to 4. And if we close above there, I still see risk of parabolic moves in yields and also in potentially oil. For sure, again, and in dollars. So I don't see, nothing has changed unless the Fed was to come in, really strongly and do some type of massive central bank global coordinated intervention and or currency swaps of size. I don't think we're going to have any change. So this is something that I wrote on FOMC Day on September 21st. Another 100 basis point increase in the 10-year would bring us to that 2023 target of 4.7. We're already at 4 and pushing up, every day. And that would, in fact, bring us down in bonds to TLT. And I think the market itself could fall another 20%. That's like 8,800 in NASDAQ. That's not on anyone's bingo card this year. That's around 3,100 in SPX. That's not on anyone's real bingo card this year, meaning there's analysis and then there's risk management of positions. I don't know if anyone really anticipated this, drumbeat lower in the risk parity trade, right? And where we're going to start to stabilize, as I've shown with my bond proxy ratio analysis and also bonds themselves. I don't see a bottom. It's not in yet. It has to drop and then stabilize and then turn higher. And this intraday bounce that we had on single stock, gamma option explosion is just not a trend reversal. It does not a trend reversal make. So anyway, I got asked that question. Does today prove that we have a start to a multi-week rally? And my answer was I want to see follow through. Obviously, I want to see volume come in and stay into the market. I want to see breadth recover. I want to see, currency stress, get relieved. The move index is freaking high. The FX index of volatility is also stunningly high. Bonds are still imploding. So I don't see how one day is a trend reversal. That's me.
Yeah, no, look, I think, I agree with that. I mean, I think the question is where, I think what people are looking for is, what constitutes financial instability? What are the things that will spook the Fed, kind of force some reaction? Where is the Fed's reaction function? They keep telling you it's not here, the put is lower, but we got to 3,500 and all of a sudden people believe that the put's here. So I think we need to try to identify, where the breakages are, where they're more likely to be. Are pegs breaking? Or is there a dollar peg that breaks? Is there, like I said, an ally that is having a bond issue? Clearly, the UK is kind of front and center with that. And so, like I said, I think historically, when things really get rough, people start to fear deflationary busts, and so that's what I'd be looking for as a signal to say the Fed needs to do something. I mean, we go back to the repo crisis of 2019. In September of 2019, you saw that. You saw that in COVID. You saw that in 1998 with LTCM. You saw it in the financial crisis. It's as these inflation expectations plummet and fears of a deflationary bust start to rise, you're moving closer to a point where the Fed needs to do something.
Yes.
And so that's what I'm looking for to, as proof that we're closer to the end game of the tightening. And frankly, we were going the opposite way. So
I know, and I have to point out this great chart, which is basically interest, right, on our U.S. public debt, is now going to very, very soon become the #1 line item in the Fed budget. And that is what everyone dreads, right? So there's no weakness here in this ascent. I have this wonky little intermarket chart that has helped me anyway, as it relates to the bond, fall relative to the Fed budget, and also the 5-year, yield with the Fed funds future rate. And it basically on a big time frame, this happens to be monthly to show multiple decades, we've come into this kind of technical level of when a rate hiking cycle ends, right? We're in one strongly right now. And I love how I can chart anything, right?
yeah.
So this is a trend line of, oh my goodness, look at that. It matched with June 2000. And it came really close in July of 2006. And anyway, so we have this, trend line of substance, and then kind of a major trend line of substance, where I was looking at, well, maybe Fed will pivot, or maybe they're going to, be way aggressive. And clearly they're not done. Inflation sticky and all of that. Employment rate is still extremely low, and wages are rising. But this really tells me the Fed is trapped. So minimum December. I mean, this is how I interpret my chart. Okay, minimum December, they finally announce, okay, we've done our job. They're not going to say anything until then, but December is when they actually announce. Maybe they try to pause or really signal a pivot. They don't get very far. Again, this is on a monthly big picture, and we go right back into weakness right after that. So I'm not seeing, again, for my intermarket that their rate hiking is done. I still think we have some lower levels, and it's going to be a very nasty next year. I think they're going to have a really hard time of bringing this back. So that's my baseline bet on Fed pivot and what it means for a higher interest rate regime. I'm still obviously bullish, and with that, then I'm market bearish. But obviously, we can chase and swing the bounces. I'd like to see if we get any follow through with this by Monday. Otherwise, I think we're going to have more weakness. And I think the same market structure that came in to support this strong bounce at 3,500, right, this morning after Europe closed and some headlines hit and what have you, this and created that delta hedging in optionality can happen again in the reverse. So I guess basically careful on your time frames and position size. So avoid the whiplash. Thank you so much, for doing this. I mean, I wanted to first kind of share what we respectively saw, since we're running our respective services for LaDuc Trading, which is kind of great for clients. They get the best of both worlds. Again, Craig runs MacroADVISOR as well as our Edge product. Edge is very much focused on customized presence versus, and then a lot of both bespoke kind of consulting for clients, Bloomberg chat, the like. It's also very much where he provides a lot of trade support. MacroADVISOR is an upgrade to our FishingCLUB, which I run, and he's able to post in Slack along with myself and 7 other contributors, by the way. So we cover everything: futures, commodities, oil, you name it. So we actually have a very robust service at LaDuc Trading, including, the core FishingCLUB, which has my live trading room, and it has all the contributor channels. The upgrade is specific for Craig's macro take that he posts in Slack. The customization of Edge is unparalleled. That's where you get all of Craig. So a lot of engagement, a lot of trade management, a lot of bespoke consulting. But that MacroADVISOR, for those who are interested in the FishingCLUB upgrade, it's so well worth it. His takes on credit stress, as well as all of these questions that I have about what's really happening in fixed income, has helped tremendously to make me a better analyst and trader and educator for my clients. So I want to just, again, thank you so much for joining. We launched this product, MacroADVISOR and MacroADVISOR Edge. It is an upgrade from FishingCLUB and a separate product in Edge for those who really want that customization and customized presence. So I just wanted to, and James is going to send out, I believe, a promo, which is for those who want to join and check this out. He's got an incredibly sweet offer, because I know that, kind of new for some folks. And Craig is, you're understated, Craig. You got to say, you're not looking for the light on Twitter. You're a solid analyst and trader. So your risk management is where you spend your time, not Twitter. So we want to spread the word. We want to ask you to also spread the word, and we will be offering a very substantial discount for the next month for MacroADVISOR. And thank you again for your time today. We'll get this up on YouTube, and hopefully some of this conversation and charting will be helpful for managing the risk coming down the pike, because we don't think it's done.
Yep.
Know what you own.
Right.
Thank you so much, Craig.
Absolutely. Thanks.
Cheers, everyone. Bye.
Bye.